Today's stock market is a high-speed race with wild swings, which can stress out any investor. But here, self-made billionaires inspire us to stay determined through their success stories, and of course, it is easier said than done. Hello everyone, and welcome back to our channel. In this video, we'll be going to talk about 3 warnings of Warren Buffett for investors of the stock market. So without further ado, let's get started. Warren Buffett's path to profits. You know, Warren Buffett has a name in the championship of value investing. He believes in a refreshingly simple investment philosophy. However, his main goal is to achieve well-managed business with favorable and durable economic characteristics, whereas his remarkable portfolio can be divided into different groups based on their contribution to his bottom line. Usually, the billionaire approach of Warren Buffett involves assessing the probability of losing capital in a transaction, backing strong and diligent managers, and evaluating the intrinsic value of an investment. Certainly, he defines intrinsic value as the discounted value of the cash that can be taken out of the business over its remaining life, using owner earnings as the cash figure for his calculation. Furthermore, Buffett believes in considering long-term economic value net of all costs, not just for accounting expenses. Fortunately, he uses his sixth sense a lot. This is the reason he's cautious about mark-to-market practices, as he views volatility in the bottom line as a distraction. For Buffett, it's crucial to invest in businesses that are understandable and not overly complex to calculate intrinsic value accurately. Undoubtedly, he stays true to his straightforward and successful value investing principles. The hidden dangers for investing. Do you guys have stumbled upon some real pearls of investing wisdom from Warren Buffett and Charlie Munger? If not, then here you go. In his letter to Berkshire shareholders, Buffett shared some timeless quotes. "If you don't see the world the way it is, it's like judging something through a distorted lens." So true, right? While the problem is Wall Street and investors that place so much emphasis on earnings, every quarter stocks go on a roller coaster ride based on how their earnings compare to analysts' expectations. It's like a never-ending earnings showdown out there. Even though the most commonly used valuation metrics revolve around earnings, whether it's the price-to-earnings P/E ratio or the price-to-earnings-to-growth PEG ratio, it all comes down to those darn earnings figures. Now, don't get me wrong, Buffett and Munger give importance to earnings too. Buffett mentioned in the letter that they favor operating earnings as their go-to figure. For Berkshire Hathaway's 2022 performance, he proudly cited the company's record earnings of $30.8 billion. But here's the thing. Buffett's warning matters a lot for all the investors out there, because he's not talking about adjusted earnings, those tricky numbers that companies sometimes use to factor out unusual stuff. Nope, he's talking about operating earnings calculated using generally accepted accounting principles, GAAP. That's the real deal. And my dear investors, even if a company's management doesn't manipulate earnings, Buffett's caution still holds. He made it crystal clear that viewing earnings on a quarter-by-quarter basis can be misleading. The media loves to make a fuss about those fluctuations, but they're often just noise that misinforms investors. So remember, when it comes to earnings, take a step back, look at the bigger picture, and don't get shaken by the short-term frenzy. Stay focused on the long term and keep those distorted lenses far, far away. Top 3 Warren Buffett warnings for investors. 1. Invest with clarity. In one of his letters, he pointed out something that's always been a concern in the investment world: the trustworthiness of earnings figures. Buffett cautioned investors not to take companies' operating at face value. Why? Because those figures can easily be manipulated by managers who want to paint a rosier picture than reality. And you know how it goes. Some CEOs and board directors out there see it as some sort of sophisticated game to engineer positive earnings results. It's like they think they're pulling off a magic trick or something. And guess what's even worse? Some reporters buy into this trickery and cheer when companies beat expectations, considering it a great managerial achievement. But Buffett doesn't buy any of that for a second. He's not one to mince words and didn't hold back in expressing his opinion. He finds this whole situation utterly disgusting. He straight up called it bold imaginative accounting, which is just a fancy way of saying deception. According to Buffett, these practices are one of the shame of capitalism. And you know what? He's right. Manipulating numbers that take zero talent. It's just like a deep desire to deceive others. It's like they're playing with people's hard-earned money, and that's just not cool. So Buffett's warning is a reminder to stay vigilant and dig deeper into a company's financials before making any investment decisions. 2. Know before you buy. As we all know, Warren Buffett is quite the character when it comes to technology. He's not into email at all and prefers good old-fashioned printed documents. So it's no surprise that he became the largest shareholder in a printer maker HP in the first quarter. I mean, he's practically keeping them in business. And when it comes to his investments in the energy sector, Buffett has a unique perspective. His ownership of railroad giant Burlington Northern and other industrial companies gives him an inside view of the demand for fossil fuels. So it's no shock that he's been putting billions into companies like Chevron and Occidental. He knows the industry inside and out and is making moves accordingly. One thing you can say about Buffett is that he sticks to what he knows. He's been purchasing stocks of companies he truly understands for ages, and it's proven to be a wise course of action. And you know what? There's a lesson we should all take to heart. If we don't understand what a company does or how it operates, why on earth are we buying its stock? So the main point is, do your homework, invest in what you understand, and don't get confused by flashy trends or hot tips. That $2 biotech stock might sound exciting, but if you can't make head or tail of what they're doing, it's probably best to steer clear. So mesh all these lessons together to get a solid B. Happy trading, everyone. 3. Don't bet against America or stocks. Man, it's pretty clear from the selling in both Warren Buffett's secret portfolio and the massive $338 billion investment portfolio he oversees that most stock valuations aren't looking too appealing right now. It's like a warning sign for investors telling us to be mindful of what's going on. But wait, let's not forget history here. Over the past 73 years, the S&P 500 has faced a huge 39 double-digit corrections. And guess what? Every single one of those 38 previous declines was eventually recouped by a bull market rally. It just goes to show that while corrections are a natural part of the market game, investors who stick around are often rewarded for their patience. Whereas he's all about time in the market and not trying to predict the best time to jump in or out. And you know what? It's hard not to argue with his logic, especially when you see that the S&P 500 has been averaging a solid 9.9% annualized total return. That's some impressive stuff. Even in the face of bear markets, crashes, and panics, those S&P 500 index investors have been doubling their money every 7 years and change for almost 6 decades, and that's worth reinvestment. Oh, and let's not forget about the U.S. gross domestic product, GDP. It has a well-defined trend, it's moving up and to the right. There, the downfalls are a normal part of the economic cycle, but here's the thing. Periods of expansion tend to last much longer than downturns. And guess what? Buffett and his team at Berkshire Hathaway know this too. They've set up their investments to thrive during these long bull markets, mostly by acquiring and investing in cyclical businesses. So here's to being optimistic and keeping our eyes on the long-term prize. Alright guys, that's all for today. Thanks for watching. Please hit that like button, share, and subscribe button to stay connected.